If you hold silver physically through futures contracts, or even as a quiet conviction you rarely talk about, what unfolded over the last 10 days may be one of the most important episodes this market has seen in years, not months. This was not a routine pullback, not a technical breather, and not a random bout of volatility. It was a shockwave that exposed how fragile, leveraged, and rule-dependent the modern commodity system has quietly become. At first glance, it looked familiar. Silver had been on a historic run. Prices had more than doubled year over year. Momentum was accelerating, and traders were whispering about breakouts not seen since the Hunt brothers era. Charts were turning vertical. Sentiment was euphoric. Risk models were being stretched to their limits. Then, in less than a week, the rally didn't merely slow, it was cut in half. Prices that flirted with the mid-80s collapsed into the low 70s, marking one of the sharpest corrections in recent silver history. Billions in paper value evaporated almost overnight. To anyone watching only the chart, it looked like panic, like something had broken, like demand had vanished. But that interpretation misses the truth. This was not a collapse driven by fundamentals. It was a mechanical event, one triggered not by weakening demand, not by economic contraction, and not by a sudden shift in industrial usage. The catalyst was structural, technical, and largely invisible to anyone who doesn't understand how futures markets actually function. The trigger came from Chicago. The CME group, the exchange that governs silver futures, pulled one of the most powerful levers in modern markets: margin requirements. Not once, not gently, but rapidly, repeatedly, and aggressively. Within a single week, the cost of holding the same silver contracts surged by nearly 50%. To understand why that matters, you have to understand what margins really are and what they are not. Margins are not opinions. They are not forecasts. They do not mean the exchange believes silver is overvalued or about to crash. Margins exist for one reason only: to protect the clearinghouse from default during extreme price moves. But when margins rise sharply and suddenly, they do something else, something far more destructive in the short term. They force liquidation. There is no discretion involved, no debate, no soft landing. If you are leveraged and long, you either post millions in additional capital immediately, or your position is liquidated. Period. That is how this sell-off began. It was not fear, it was math. Accounts that had built large leverage positions during the rally suddenly found themselves undermargined. The price hadn't even collapsed yet, but the rules had changed. Overnight, the same exposure required dramatically more cash. For many traders and funds, that cash simply didn't exist on short notice. They had no choice but to sell. Once those sell orders hit the market, everything else followed. Stop losses triggered, algorithms reacted, technical levels broke, liquidity thinned. What looked like a spontaneous collapse was actually the market's plumbing reacting to tightened rules. And here's where the story becomes far more interesting. While the futures market was being hammered, the physical silver market told a very different story. In major physical hubs, across the Middle East, parts of Europe and Asia, prices did not collapse in the same way. In Egypt, for example, silver retreated modestly from historic highs, but still finished the week far above year-earlier levels. Physical premiums remained stubborn. Supply did not suddenly flood the market. That divergence between paper prices and physical reality is not noise, it is a signal, and it forces us to rewind the timeline. Silver's meteoric rise did not begin with hype. It began with a structural deficit. For years, global mine production has failed to keep pace with demand. Industrial consumption, from solar panels and electric vehicles to data centers, AI infrastructure, aerospace, and defense, has quietly absorbed more silver than the market replaces. This is not speculative demand. Silver is embedded into modern technology at the molecular level. There are no easy substitutes. By late 2025, that imbalance had become impossible to ignore. Technically, silver had already broken out of a decade-long consolidation. The old resistance around $30 was long gone. By December, price action had turned parabolic, the kind of move that gives risk managers nightmares. And that is exactly when exchanges act. The CME did not intervene because silver was doomed. It intervened because volatility was accelerating faster than its risk systems were comfortable with. Clearinghouses exist to guarantee settlement. When price velocity explodes while leverage is high, the entire system becomes vulnerable. Margins that once sat near $20,000 per contract were no longer sufficient. On December 26, 2025, the CME issued its first margin increase, raising requirements to roughly $25,000 per contract. Markets shrugged. Silver kept climbing. 4 days later, the hammer fell again. Initial margins jumped above $32,000 per contract, effective immediately after the December 31st close. No gradual adjustment, no time to reposition. Leverage imploded. This two-step margin shock during a holiday week created what analysts now call a liquidity vacuum. With leverage suddenly expensive or unavailable, participants vanished, bids disappeared. Even modest sell orders created outsized price moves. This is where most commentators get it wrong. They call it bearish. But if this were a true bearish shift, physical markets would reflect it. They didn't. Demand did not evaporate. Supply did not surge. The real economy did not suddenly stop needing silver. What changed were the rules of engagement. And when rules change faster than positions can adapt, price becomes a casualty. This is not the end of the story. It is the beginning. Once the initial shock passed and prices stabilized from their free fall, a strange and deeply uncomfortable realization began to spread through the market. The silver sell-off had not resolved anything. It had merely exposed a fracture that had been forming quietly for years. The fracture was not between bulls and bears. It was between paper and physical reality. On futures screens, silver looked wounded. Volatility remained elevated, liquidity thin, conviction shaken. Commentators debated whether the rally was over, whether the margin shock had reset the market, whether this was the beginning of a long unwind. But outside the futures pits, outside the spreadsheets and risk models, silver behaved very differently. Physical markets refused to follow the script. Across major hubs in Asia, the Middle East, and parts of Europe, premiums on real metal stayed firm. In some locations, they rose. Bars and coins did not suddenly flood the market. Delivery windows did not collapse. Procurement desks did not breathe a sigh of relief. Instead, a quiet tension grew. The screen price said one thing. The delivered price said another. This divergence is not theoretical. It is measurable, and it matters. In Shanghai, Dubai, Istanbul, and regional Middle Eastern exchanges, buyers continued to pay meaningfully above futures prices for immediate delivery. Refiners did not slash offers. Fabricators did not delay purchases. Sovereign buyers did not retreat. The futures market had repriced risk. The physical market had not repriced scarcity. This is where traditional market narratives begin to fail. For decades, traders have been taught that futures prices lead and physical prices follow. Arbitrage is supposed to close any gap. If paper prices fall below physical value, sophisticated players buy futures, stand for delivery, and sell physical metal at a premium, restoring balance. That mechanism is the backbone of price discovery. But during this episode, it faltered. Why? Because arbitrage only works when confidence exists across the entire chain. Standing for delivery is not a spreadsheet exercise. It requires capital, logistics, trust in warehouse stocks, trust in delivery timelines, and trust that regulatory or policy shifts will not intervene mid-process. When margins spike, capital gets trapped. When volatility explodes, risk committees freeze. When geopolitics intrude, timelines stretch. Suddenly, the arbitrage that looks effortless in textbooks becomes fragile in reality. This is what traders call a price discovery break. It is the moment when the futures market, driven by leverage, liquidity, and rules, stops accurately reflecting the value of real deliverable supply. Historically, these breaks have been brief, hours, days, occasionally weeks. Arbitrage capital usually rushes in to exploit the spread. This time felt different. The spread persisted. Physical buyers were not convinced that paper prices represented true relief. They continued to act as if supply was tight, because for them, it was. To understand why, you have to look beyond exchanges and into the physical supply chain itself. Silver is not stored evenly across the world. It is mined in specific regions, refined in specific facilities, and consumed in specific industries. The path from mine to manufacturer is long, capital-intensive, and increasingly political. By late 2025, that path was already under strain. For the fifth consecutive year, global silver consumption exceeded mine production. Inventories declined quietly but persistently. Much of the remaining stock sat in forms or locations not easily mobilized. Official inventory numbers looked adequate on paper. Confidence in those numbers did not. This distinction is critical. Markets do not break when inventories hit zero. They break when participants stop trusting that inventories can be accessed when needed. In the weeks leading up to the margin hike, whispers circulated among procurement desks about longer delivery times and tighter availability in certain regions. Nothing dramatic, nothing headline-worthy, just enough friction to raise eyebrows. Then the margin shock hit. Prices dropped hard. From the outside, it looked like pressure had been relieved. Inside the supply chain, the same question remained unanswered. Can we get the metal when we need it? That question is what keeps physical premiums elevated even when futures prices fall. The paper market trades risk. The physical market trades assurance. This difference explains why the sell-off felt emotionally violent to traders, but oddly muted to industrial buyers. For a leveraged fund, a margin hike can destroy months of positioning overnight. For a manufacturer planning multi-year production, a futures dip is noise unless it translates into reliable supply. And it didn't. At the same time, stress points outside the West intensified. Large volumes of physical silver trade beyond the transparency of Western exchanges. Regional markets operate on bilateral agreements, long-term contracts, and state-linked procurement strategies. These markets do not respond reflexively to CME rule changes. They respond to availability. This is why the margin hike revealed something uncomfortable. The real stress in the silver ecosystem is not centralized in Chicago. It is distributed across refineries, transport routes, export policies, and industrial demand centers. And those stress points were tightening, not loosening. As this realization spread, a deeper psychological shift began. Participants started asking a dangerous question: which price is real? The screen price that moves on leverage and risk models, or the delivered price that manufacturers and sovereign buyers are actually paying? When markets ask that question seriously, trust erodes. Trust is the invisible currency behind every futures contract. It is the assumption that paper claims can be converted into physical reality without friction. When that assumption weakens, participation changes. This is exactly what happened in the days after the sell-off. Volume surged, but participation narrowed. Fewer players were willing to step in aggressively, not because they believed silver had lost value, but because they were unsure which price to believe. Uncertainty replaced conviction, and uncertainty behaves differently than fear. Fear causes panic selling. Uncertainty causes hesitation. Hesitation drains liquidity. Liquidity loss amplifies volatility. This feedback loop is why margin shocks often echo long after headlines fade. Meanwhile, physical demand marched on, largely indifferent to futures chaos. Solar manufacturers did not cancel projects. EV supply chains did not halt. Defense procurement did not pause. Silver consumption operates on strategic timelines, not intraday charts. That quiet contradiction between futures turmoil and physical persistence sat at the heart of this episode. And it set the stage for the next escalation, because while exchanges were tightening leverage and traders were nursing losses, governments and institutions were beginning to move. By the time volatility settled and the immediate shock of forced liquidation faded, a quieter but far more consequential shift was already underway. The silver market was no longer being shaped solely by traders, charts, or exchange rules. It was beginning to intersect with policy, sovereignty, and long-term strategic planning. This is the point where silver stops behaving like a normal commodity, because commodities respond to price. Strategic materials respond to control. And silver increasingly belongs in the second category. The first signal came not from Chicago or New York, but from Beijing. Effective January 1st, 2026, China implemented a stricter export licensing regime on refined silver. This was not a dramatic ban. There were no emergency press conferences, no quotas announced on television. Instead, it was something far subtler and far more powerful. A gate, a licensing process that inserted friction into global supply flows. For casual observers, this looked bureaucratic. For supply chain professionals, it rang alarm bells. China occupies a unique position in the silver ecosystem. It is not just a major producer, it is a refining hub, an industrial consumer, and a critical node in the movement of metal from mine to market. When China adjusts export rules, it does not merely affect trade, it reshapes availability. In a market already defined by tight physical supply, this mattered. On one side of the world, an exchange was pulling leverage out of the paper market. On the other side, the world's largest physical actor was slowing the outflow of metal. This was not coincidence, it was a signal. And signals like this are rarely about short-term price movements. They are about priorities. Export licensing is not about revenue. It is about ensuring domestic access first. It is about insulating strategic industries from volatility. It is about acknowledging that certain materials are too important to leave entirely to global spot markets. Silver sits at the intersection of renewable energy, advanced manufacturing, defense systems, medical technologies, and digital infrastructure. It is embedded in solar grids, electric vehicles, data centers, and communications hardware. There are no easy substitutes. When volatility enters that system, governments notice, and they respond. This policy layer collided with another force at exactly the wrong moment: institutional rebalancing. Every January, major commodity indices rebalance their allocations to maintain target weights. These indices are followed by pension funds, sovereign wealth funds, and passive investment vehicles managing trillions of dollars. In 2025, silver had dramatically outperformed. By some measures, it had risen more than 150% on the year. That success triggered a mechanical consequence. Index funds were forced to sell, not because they had lost faith, not because fundamentals had changed, but because the math demanded it. Exposure limits were breached. Target weights exceeded. Mandates had to be respected. This selling was unavoidable. Millions, perhaps billions, of dollars in silver exposure had to be reduced, regardless of market conditions. Combined with margin-driven liquidations, it created the illusion of mass abandonment. In reality, it was rule-based compliance. This is a crucial distinction. Markets often confuse forced selling with informed selling. They are not the same. Forced selling is indifferent to value. It obeys constraints. And when multiple constraints activate simultaneously, margin hikes, index rebalancing, volatility limits, the effect can overwhelm price discovery. That is exactly what happened. The chart told a story of collapse. The structure told a story of congestion. Behind the scenes, another transformation was underway. Silver was being quietly reclassified in institutional thinking. Not officially, not publicly, but behaviorally. Procurement teams, policy advisors, and industrial planners began treating silver less like a tradable input and more like infrastructure. Infrastructure is not sourced opportunistically. It is secured. It is diversified. It is stockpiled. This shift does not announce itself with headlines. It appears in longer-term contracts and bilateral agreements, in quiet accumulation that never touches futures exchanges. That is why physical premiums remained elevated even as paper prices fell. That is why delivery timelines did not suddenly shorten. That is why confidence did not return simply because charts stabilized. Markets had entered a phase where price signals were no longer sufficient. This creates a dangerous gap. When futures markets lose their monopoly on price discovery, volatility does not disappear. It migrates. It moves into policy. It moves into trade flows. It moves into geopolitics. History offers uncomfortable parallels. Every major commodity repricing of the past century followed a similar pattern. Early disbelief, rapid appreciation, excess leverage, a violent correction, then confusion. Confusion is the phase where old frameworks stop working but new ones are not yet established. Silver was now firmly in that phase. Some analysts declared the rally dead. Others insisted the correction was engineered. Both were incomplete. The exchange did not act maliciously. It acted defensively. Index funds did not panic. They complied. Physical buyers did not celebrate lower prices. They remained cautious. Governments did not intervene loudly. They adjusted quietly. Each actor behaved rationally within its own constraints. The problem was that those constraints collided. And when constraints collide, markets fracture. Silver's role as a strategic input only magnified the consequences. Volatility in discretionary commodities can be tolerated. Volatility in infrastructure materials cannot. This raises an uncomfortable possibility. What happens if price instability itself becomes unacceptable? Margin hikes suppress speculation but do nothing to stabilize supply chains. Export controls protect domestic interests but fragment global markets. Index rules maintain discipline but ignore real-world scarcity. Each solution solves one problem and creates another. That is why this episode cannot be dismissed as a correction. It is a transition. A transition from a market governed primarily by traders and exchanges to one increasingly shaped by institutions, governments, and long-term strategic planning. And transitions are rarely smooth. They are marked by sudden rule changes, conflicting signals, and prolonged uncertainty. When the charts finally stopped screaming and the headlines moved on, the most important damage from the margin shock was already done. And it had nothing to do with price. It had to do with trust. Markets can survive volatility. They cannot function without confidence in the process that produces prices. What the silver market experienced was not just a repricing, but a moment of collective doubt about how price itself is formed. That doubt lingers far longer than any sell-off. In the days following the collapse, volume spiked but participation narrowed. Fewer players were willing to step in aggressively, not because they believed silver had lost value, but because they were no longer sure which price mattered. The screen price? The warehouse price? The delivered price months from now? When those prices diverge, markets hesitate. Hesitation is not bearish, it is cautious. And cautious liquidity behaves very differently from confident liquidity. It steps back. It demands higher risk premiums. It moves slower. This is why margin shocks often echo long after volatility subsides. Traders remember how quickly rules can change. Funds revise internal risk limits. Risk committees gain veto power. Liquidity becomes selective. That selectivity alone can keep prices unstable, even when fundamentals remain unchanged. This is the psychological scar left by forced liquidation. Weeks or months of positioning can be invalidated overnight, not by demand shifts, not by new information, but by a notice posted after the close. That realization changes behavior. It encourages shorter time horizons, smaller positions, wider buffers. In other words, it resets the leverage clock. That is why some analysts argue the margin hike was healthy, a necessary purge after a parabolic move. There is truth in that view, but it is incomplete, because while leverage was flushed from the paper market, nothing changed in the physical world. Industrial buyers did not revise long-term plans. Solar manufacturers did not cancel capacity expansions. Defense contractors did not slow procurement. Data center construction did not pause because a futures contract dipped. Silver demand operates on multi-year horizons. Trading operates on margin schedules. These two timelines do not reconcile easily. This mismatch is why physical premiums refuse to collapse alongside paper prices. It is why delivery confidence, not inventory totals, became the quiet obsession of procurement teams. Confidence is fragile. And once it erodes, it does not return simply because price corrects. This brings us to a rarely discussed concept: inventory confidence. Markets focus obsessively on reported stock levels, But what matters more is whether participants believe those stocks are accessible, movable, and politically neutral. When delivery windows stretch, when premiums rise, when export policies tighten, confidence erodes, even if headline inventory numbers appear stable. In the weeks before the margin hike, subtle signs of this erosion were already visible. Nothing dramatic, just enough friction to make procurement desks uncomfortable. The sell-off did not fix that discomfort. It merely distracted attention. History suggests this phase is familiar. Every major commodity repricing follows a pattern: disbelief, excitement, excess leverage, violent correction, confusion. Silver now sits squarely in the confusion phase. Confusion is dangerous because it breeds false certainty. One camp declares the rally over, another insists manipulation explains everything. Both are incomplete. The exchange did not engineer collapse. It protected itself. Funds did not abandon silver. They complied with rules. Physical buyers did not retreat. They waited. Governments did not panic. They watched. Each actor responded rationally within its constraints. The problem is that those constraints do not align. When they collide, markets fracture. Silver's role as a strategic material magnifies this fracture. Volatility in discretionary commodities is tolerated. Volatility in infrastructure inputs is not. This raises an uncomfortable possibility. What happens when governments decide that price instability itself is a problem? Margin hikes can suppress speculation but cannot stabilize supply chains. Export controls protect domestic access but fragment global trade. Index rules enforce discipline but ignore real-world scarcity. Each intervention shifts stress elsewhere. Stress never disappears. It migrates. This is why the margin hike should not be viewed as an ending. It was an interruption, an inflection point. It bought time. Time for leveraged players to recalibrate. Time for physical flows to assert themselves. Time for policy responses to evolve. Time for price discovery to decide where it actually belongs. That is why this moment feels so unsettled. Prices fell, yet uncertainty rose. Volatility spiked, yet conviction weakened. Headlines screamed collapse while physical demand whispered persistence. These contradictions do not cancel each other out. They accumulate. And when contradictions accumulate long enough, something eventually gives. Will it be price, structure, participation, or the mechanism through which silver is priced at all? That question remains open. What is clear is this. The silver market of 2026 is no longer just about sentiment, technicals, or even fundamentals in isolation. It is about frameworks. Who sets the rules, where prices are discovered, and whose interests those prices serve. This episode revealed something many prefer not to acknowledge. The CME margin hike did not create volatility. It exposed it. Volatility was already embedded in a market where leverage had become cheap, positions crowded, and paper pricing drifted far from physical reality. The margin hike turned the lights on. Once the lights are on, psychology changes. Trust becomes conditional, liquidity becomes cautious, and markets become quieter, but not simpler. As charts stabilize and commentary fades, do not mistake calm for resolution. The forces beneath the surface are still shifting, still negotiating, still pulling in opposite directions. Until those forces align or collide, this story is not finished, not even close.